Most financial crises feel like a surprise attack. A bank collapses on a Friday, a currency peg breaks on a Monday, or a pandemic shuts down the world in a week. They are sudden, violent shocks that no one saw coming until they were already here. But the crisis forming right now is different. It is not a surprise. It is a scheduled event. It is a mathematical certainty written into the legal contracts of millions of loans signed 3 to 5 years ago. We call it the maturity wall. And while the mainstream media is still debating whether we will have a soft landing or a hard landing, they are missing the fact that the runway itself is about to run out. To understand why 2026 is the year the math breaks, we have to look back at the anomaly of 2020 and 2021. During those years, the world was flooded with the cheapest money in human history. Central banks slashed rates to zero and governments printed trillions. Corporations, real estate developers, and private equity firms gorged themselves on debt. They didn't just borrow to survive, they borrowed to expand, to buy back stock, and to acquire assets at record high valuations. But here's the catch. Corporate debt is not like a 30-year home mortgage. It doesn't lock in a rate for decades. Corporate and commercial real estate loans are typically short-term, usually 3 to 5 years. They are designed to be rolled over or refinanced. The assumption is always that when the loan comes due, you simply take out a new loan to pay off the old one. It's a perpetual motion machine that works beautifully as long as interest rates stay low and asset values stay high. But in 2026, a massive wave of these 5-year loans from the peak of the need-free money bubble will expire. We are talking about over $1.5 trillion in commercial real estate debt alone coming due by the end of 2026. If you include broader corporate debt and leveraged loans, the number swells toward $3 trillion. This creates a structural choke point that the global economy has not faced since 2008. The problem is simple. The loans coming due were originated at 3% interest rates. Today, the cost to refinance them is 7% or 8%. For a healthy business, that's painful. For a highly leveraged business, or a bound zombie company that barely covers its interest payments, it is a death sentence. And this brings us to the hidden structural shift that most people are ignoring, the reset of asset values. For the last decade, the price of everything, from office towers in Manhattan to logistics centers in Europe, was calculated based on the assumption of cheap debt. When you remove cheap debt, the math that justifies those prices collapses. But, and this is critical, the prices haven't collapsed yet. Why? Because of a banking strategy known as extend and pretend. For the last 2 years, banks have been quietly refusing to foreclose on bad loans. Instead, they have been granting short-term extensions, hoping that interest rates would crash back down to zero before the bill came due. They are buying time. They are keeping the patient on life support to avoid marking down the value of their loan books. But time is up in 2026. The volume of debt maturing is simply too large to extend any further. The banks are running out of capital buffers, and regulators are starting to ask questions about the ghost assets on their balance sheets. This means we are approaching a moment of forced transparency, a moment where the true value of assets is discovered not by an appraiser's spreadsheet, but by the brutal reality of a cash call. And when $1.5 trillion needs to be refinanced in a market that no longer wants to lend, cash becomes the most expensive commodity on earth. This is not just a real estate story. This is a story about the solvency of the entire post-COVID economy. Because when these loans mature, the borrowers will have 3 choices. 1, pay off the loan with cash, which they don't have. 2, refinance at double the interest rate, which destroys their profit margin. 3, default and hand the keys to the bank. In 2026, millions of contracts will hit this decision point simultaneously. It is a margin call for the entire economy. And for the viewers of this channel, the goal is not to panic. It is to understand that we are moving from an era of asset inflation, where everything goes up because money is cheap, to an era of asset rationalization, where prices fall to match the cost of capital. This is the great filter. The companies and investors who survived on cheap debt will vanish. Those who held cash and understood the cycle will step in and buy the world for pennies on the dollar. The wall is visible. We know exactly when we hit it. The only question is, who has their seatbelt on? To understand the severity of what is coming in 2026, you first have to understand the deception that has kept the economy looking stable for the last 2 years. In the banking industry, there's a dirty secret known as extend and pretend, or sometimes delay and pray. Here is how it works. Imagine you are a bank. You lent a developer $100 million in 2021 to buy an office building. At the time, the building was appraised at $150 million and the loan interest rate was 3%. Everything looked safe. Fast forward to today, the building is half empty because of remote work. Interest rates are 7%. And crucially, the building is now only worth $80 million. Technically, the borrower is underwater. The loan is worth more than the asset. In a normal market, the loan matures, the borrower can't pay, and the bank forecloses. The bank takes the building, sells it for $80 million, and records a $20 million loss. But banks hate recording losses. Losses hurt their stock price. Losses reduce their capital reserves. Losses invite regulators to look closer at their books. So instead of foreclosing, the bank does something clever. They call the borrower and say, "Hey, we know you can't pay the $100 million, so let's just pretend this loan isn't due yet. We will extend the maturity date by 1 year. You keep paying the interest, and we won't mark this loan as bad on our balance sheet." Everyone wins, right? The borrower keeps the building. The bank keeps its perfect record. The illusion of solvency is maintained. This is exactly what has been happening since 2023. Data from the Federal Reserve and private analysts confirms that banks, especially regional banks with weaker capital, have been systematically extending the maturities of distressed CRE loans to avoid writing off their capital. They are effectively painting over rust and calling it steel. But here's the problem with extend and pretend. It only works if the problem is temporary. It works if you believe that in 12 months, rates will drop back to zero and the building's value will shoot back up to $150 million. But we're now heading into 2026, and the market is realizing that higher rates are not a glitch. They are the new normal. The maturity wall of 2026 is the moment where the extensions run out of road. You can extend a loan for a year, maybe 2, but you cannot extend it forever, especially when the volume of maturing debt jumps by 56% in a single year. The sheer size of the 2026 maturity wave means banks simply do not have the balance sheet capacity to keep pretending. Regulators are already tightening the screws. The Basel III endgame rules are forcing banks to hold more capital against risky assets. They can no longer afford to carry billions of dollars of zombie loans that pay 3% in a 5% world. This means that in 2026, the banks will stop extending. They will start demanding payment, and that is when the pretend ends and the liquidation begins. We are already seeing the cracks. In Q3 2025 alone, the volume of distressed commercial real estate reached $126.6 billion, up 18% from the previous year. That is the water leaking through the dam. And the victims of this shift won't just be the reckless developers, it will be the passive investors, the pension funds, the REITs, and the mutual funds, who bought into these assets believing the valuations were real. They are holding paper that says an asset is worth 100 when the market is about to price it at 60. This mechanism of hidden losses is the structural rot beneath the floorboards of the economy. It explains why the stock market can hit all-time highs while Main Street feels like it's in a recession. The financial economy is effectively lying to itself about the value of its collateral. But gravity is undefeated. When the maturity wall hits, the extension option disappears. The only options left are recapitalization, putting in more cash, or default. And as we will see in the next section, asking borrowers for more cash in 2026 is like trying to squeeze blood from a stone. The banking system has built a trap for itself. By refusing to take small losses in 2023 and 2024, they have guaranteed a massive concentrated realization of losses in 2026. They kicked the can down the road, but they just kicked it into a brick wall. So what happens when the bank finally says no? So how does this story end? Does the world end in 2026? No. The factories don't vanish. The buildings don't collapse, physically. The underlying economy of goods and services continues. But the financial claims on that economy are about to be completely rewritten. We are witnessing the end of the financialization era, the 40-year period where you could get rich simply by using leverage, debt, to buy assets. That game is over. The new era is about liquidity and operations. The winners in the post-2026 world will not be the financial engineers who know how to structure a complex loan. The winners will be the operators who know how to run a profitable business that generates actual cash flow. For the economy, this is painful but necessary. It is a forest fire that burns away the dead wood, the zombie companies and reckless speculators, so that new growth can emerge. But the transition will be turbulent. We will likely see 1. A credit crunch. Banks, burned by the CRE collapse, will stop lending to small businesses. It will become incredibly difficult to get a loan for anything other than a guaranteed winner. 2. Deflation in asset prices. The price of commercial real estate, luxury assets, and non-profitable tech stocks will likely grind lower as the refinancing premium evaporates. 3. Inflation in services. Paradoxically, while asset prices fall, the cost of services might rise as businesses hike prices to cover their higher debt costs. For you, the viewer, this hidden structural shift presents a specific set of risks and opportunities. The risk. If your income or your business depends on easy credit, you are in the danger zone. If you work for a company that is loaded with debt and barely making a profit, understand that their runway ends in 2026. If you are holding assets like real estate syndications or speculative stocks, Let rely on a greater fool to buy them out. The music is about to stop. The opportunity. This is the moment for vulture investing on a personal scale. Cash is currently trash in the minds of many because of inflation. But when the maturity wall hits, cash becomes the ultimate option. In 2026, you will likely see high-quality assets, businesses, real estate, equipment, selling for prices we haven't seen in a decade. Not because they are bad assets, but because their owners have a liquidity event, the loan maturity, that they cannot solve. They will be forced sellers. You want to be the voluntary buyer. This is why industrial hoarding, the theme we discuss with silver, is also relevant here. The smartest players are currently hoarding liquidity. They are building cash piles, reducing their own debt, and waiting on the sidelines. They are letting the extend and pretend crowd exhaust themselves. The 2026 maturity wall is the great filter. It separates the solvent from the insolvent. It validates the thesis that stability is an asset. In a world of 3% rates, stability was boring. In a world of a refinancing crisis, stability is the only thing that matters. So, as we move closer to this date, ignore the daily stock market fluctuations. They are noise. Watch the credit spreads. Watch the corporate bankruptcy filings. Watch the bank loan loss reserves. Those are the tectonic plates moving beneath the surface. The extend and pretend party was fun while it lasted. But the lights are coming on. The bill is on the table. And in 2026, the bouncer comes to collect. Stay liquid. Stay educated. And don't be the one holding the bag when the wall hits.